Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. I ran 2 deals through our cash flow calculator last Tuesday night. Cleveland duplex, Austin condo, same mortgage rate, same down payment percentage, same reserve estimates. I stared at the results for about 30 seconds before I closed the laptop. The Cleveland duplex cash flows $270 a month. The Austin condo doesn't just lose money. The mortgage, insurance, and taxes alone exceed the rent by $680. That's before vacancy, before repairs, before management. The non-negotiable costs are already more than the building earns. And the kicker? The Cleveland investor put down $52,500. The Austin investor put down $75,000. More money in, worse result out. That's not a bad deal. That's a bad zip code. Hey, Prime investors, Martin Maxwell here. Welcome back to the 5-Minute Prime Podcast. Back in episode 112, I introduced the Tier 2 Trinity, Cleveland, Birmingham, KC. I said the Midwest was underpriced, underfollowed, and about to outperform. That was December. I caught some heat for it. A few of you emailed me and said I was cherry picking. Well, the spring data is in, and it's not subtle. Today, I'm going to walk you through what I'm calling the two-speed market. One side of the country accelerating, the other one flooding. And the 3 numbers that tell you which speed your target market is running at. No financial advice here. Education only. Do your own due diligence. The lie in the national average. Let me start with the headline number. U.S. home prices grew under 1% year over year in January, 0.74% to be exact. That sounds flat, stable, almost boring. Here's the thing, it's a lie, a mathematical lie. Dig into the regional splits and the story is completely different. The Midwest posted 3.56% growth. Cleveland led every major metro in the country at 4.5% annual appreciation. Now, flip the map. Florida, negative 2.36%. Texas, down over 1%. Colorado, negative 1.31%. Same country, opposite trajectories. And the national average? It's just the two canceling each other out. And here's where it gets really interesting. Look at rents. Cleveland rents are up 3.15% year over year. Average, $1,575. That number's been climbing steady for 2 years. Austin, down 6.8%. Not flat, not softening, down. Landlords in Austin are giving away 4 to 12 weeks of free rent to fill units. Half of all Austin rental listings have concessions attached right now. Free months. Waive deposits. Some buildings are throwing in free parking just to get a signed lease. In Cleveland, I checked, 0 concessions, not 1%, 0. If you already own in the Sun Belt, don't panic. This isn't about selling. It's about knowing your real numbers before you buy the next one. That's the two-speed market. 2 engines running at completely different RPMs. And the spring listing data just confirmed it. New listings surged 29% in a single week heading into April. But that inventory isn't spread evenly across the country. It's concentrated in the Sun Belt, markets that built too much too fast at the wrong time. The Midwest barely blinked. The supply moat and the costs nobody models. So why is the split happening? And a more important question, is it temporary? Let me give you the structural answer. I'm calling it the supply moat. The Midwest is the only region in America, literally the only one, that delivered fewer multifamily units than its 10-year average. About 12,100 apartments in Q3 of 2025. Sunbelt markets delivered multiples of that. Austin alone permitted more apartments in 2023 than Cleveland permitted in 5 years. What happens when you flood a market with supply? Rents drop, concessions spike, landlords end up competing with each other on price and losing. I warned about this back in episode 46, the hot market hype trap. Austin is the trap now. Jacksonville, Phoenix, pick your Sunbelt metro. What happens when supply stays tight? Rents hold, they grow, and the landlord sets the terms. That's the Midwest story right now. Cleveland, Birmingham, KC, the moat isn't a wall, it's the absence of a crane on the skyline. And it's structural. You can't build your way out of it in a year. Now here's the part I almost missed. When I first ran these deals, I used the same assumptions I always do. Purchase price, rent, taxes, mortgage. Standard stuff. Looked reasonable for both markets on the surface. Then I plugged in real insurance quotes. Cleveland, $1,200 a year. That's $100 a month. Austin, $3,600 a year. $300 a month. Texas premiums are up 56% since 2019. And Insurify projects, they'll keep climbing. That's $2,400 more per year. $200 a month, gone, before a single rent check clears. That one line item changes everything. I'm calling it the insurance spread. Zillow doesn't show this. Your agent's pro forma doesn't either, but your bank account shows it every single month. And it stacks. You add the insurance spread on top of what I'm calling the concession tax, the cost of operating in a market where you have to bribe tenants with free rent just to fill a unit, and your Sunbelt cash flow isn't just thin, it's gone. 2 deals, 1 calculator. Let me make this concrete. I want to run both deals right now, the way I did it Tuesday night, so you can hear exactly where the math breaks. Deal 1, Cleveland. Duplex in Tremont, 2 miles from the Cleveland Clinic campus. Purchase price, $210,000. In Cleveland, that gets you a 2-unit building. Both units rented. Combined gross rent, $1,850 a month. Put 25% down. That's $52,500 out of pocket. Mortgage on $157,500 at 6.38%, $982 a month. Insurance, $100. Property taxes at 1.8%, $315. Vacancy and repairs reserves at 10% of rent, $185. Net cash flow positive $268 a month. Cap rate 7.1%. DSCR 1.27. That's positive leverage. The building earns more than the debt costs. That deal works. No rate cut needed. No appreciation gamble. The cash flow is real on day 1. Now, deal 2. Austin. Condo near the Domain. Historically a strong rental submarket. Purchase price $300,000. In Austin, that gets you a 1-bedroom. Gross rent $1,525 a month and falling. Same 25% down, but now that's $75,000. $22,000 more than Cleveland. Mortgage on $225,000. $1,404. Insurance $300. Property taxes at 2.2%. Texas, no state income tax. High property tax, $550. Like, stop right there. Just those 3 line items, your mortgage, your insurance, your taxes, that's $2,254 a month. The rent is $1,525. You're already $729 underwater. Before vacancy, before a single repair, before you even think about management, negative cash flow, cap rate under 2%. And the DSCR, your debt service coverage ratio, the number lenders use to decide if a deal works, 0.34. Anything below 1.0 means the building doesn't earn enough to pay the loan. This one isn't even close. That's not a deal. That's a donation. Here's what makes this painful. The Cleveland investor put down $52,500 and makes $268 a month. The Austin investor put down $75,000, $22,500 more, and loses money every single month. More cash in, worse result out. My point of view is this: stop waiting for rates to drop and start looking at markets where the math already works. The rate isn't your problem. The zip code is your problem. It's always been the zip code. Your challenge today: run this comparison yourself. Pick a Midwest market and a Sunbelt market. Same price range. Pull real rent estimates, real insurance quotes, real tax rates. Plug them into the cash flow calculator on reiprime.com or any spreadsheet you trust. Run both deals side by side with the same assumptions. Your numbers are going to tell you what I just told you, but they'll be your markets, your deals, your math. If the Midwest deal pencils and the Sunbelt one doesn't, your next step is to find a local property manager or agent in that metro and run 3 more deals this week. That's how you move from research to action. That's the 2-speed market, and the math makes the decision for you. Next episode: the most popular deal screening shortcut in real estate doesn't work anymore. The 1% rule, rent has to equal 1% of purchase price, hasn't cleared a real deal since rates hit 6%. I'll tell you what replaced it. I'm Martin Maxwell. Keep learning, stay strategic, and keep building, one step at a time.